Welcome back everyone, I hope you're having a great day, and in this episode we're going to take a look at 3 REITs that may be a great buy in 2023. The 3 companies we're going to take a look at all have very different operations, so they can provide great diversity within the real estate sector. All companies are growing revenue and cash flow year after year while paying out a growing dividend to their shareholders, so if you're looking to add some passive income into your portfolio, these are 3 REITs definitely worth taking a look at. But before we jump into that first REIT, I am going to ask you to please hit that like button and subscribe. I'm the Gen Z investor, and on this channel we talk about the stock market, go over any major market news, and we track the progress on my personal portfolio that has a value of $177,000. So please hit that like button and subscribe. And in this video, we're going to focus on 3 REITs. We're going to take a look at their current operations, their historical performance, and some future expectations. So right now we're going to jump into that first company, which is ticker MAA for Mid-America Apartment Communities. They currently trade for $160 per share, and over the last 12 months, the shares are now down by 27%. If we zoom out and take a 5-year perspective, the shares are up 72% in share price appreciation over the past 5 years. The company is sitting on the low end of the 52-week range and trades with a price to FFO ratio, which is for REITs very similar to the price to earnings ratio of a company at 19. They have a current dividend yield at 3.5% and a market cap at $19 billion. Next, if we take a look at the company's Morningstar report, we can see they are currently ranked as 4 stars with an estimated fair value per share of $180. They're currently sitting around $160 per share, meaning they're trading at an 11% discount from their estimated fair value according to Morningstar. So you can pick up a company that has a nice starting yield at 3.5%, but is also considered undervalued with Mid-America right now. If we move on to their latest investor presentation, we can see the company's built up their real estate portfolio to now have over 102,000 individual apartment units. They have an A- credit rating according to S&P, and their 10-year annual compounded growth rate is at 13.2%, meaning over the past decade, this individual company has outperformed the S&P 500. And since the firm's IPO, they've paid out 115 consecutive quarterly cash dividends to their shareholders, and this dividend payment continues to grow year after year. And if we take a look at where their units are located, all across the southern region of the United States, they continue to expand to more states over time. They're not solely focused on one market for majority of their properties, and we can see the top 3 cities include Atlanta, Dallas, and Tampa, Florida. But overall, they continue to grow and expand their diversity all across the southern region of the United States, which is great to see. And overall, if we take a look at some financial metrics, year over year, their funds from operations continue to grow, which is exactly what we're looking for. In the full year 2022, it's expected to generate $8.45 per share. And if we take a look at their 20-year annual return, we can see a 15% CAGR over the past 20 years. That's absolutely incredible. Not only the past decade have they outperformed the market, but for over the past 20 years, this company has outperformed the S&P 500. And if we take a look at their dividend history, over a long period of time, it continues to grow from $2 back in 1995 to all the way close to $5 per year per share in 2022. So long-term consistent growth in that annual dividend payment. And if we take a look going forward, with interest rates rising, a lot of REITs are in trouble if they have variable rate mortgages. But if we take a look at MMA, this company currently has a weighted average interest rate across their entire debt portfolio of only 3.4%, which is very manageable, and 97.2% of their total debt is at this average fixed rate of 3.4% with 8 years weighted maturity. That's a great sign for MMA investors. This company has a long-term growth rate of expected future rents as well. Their debt level is at a pretty solid rate at only 3.4%. They have another 8 years, so hopefully over that period of time, interest rates come down when it's time to refinance, and 97% of their debt is at this fixed rate. So these rising interest rates we've seen over the past year have not really hurt the company with their existing debt. Of course, new debt may come at a higher interest rate, but their existing debt on the books is pretty much covered by their funds from operations by a safe margin. And going forward, they also have a ton of developments in the pipeline with an average expected value of over $1 billion of future developments to be finished and stabilized through 2023 and into 2024. And if we take a look at their income statement, continuous revenue growth year after year, $1.5 billion back in 2017, slow and continuous expansion year after year, which is exactly what you're expecting from a residential REIT, to close to $2 billion in top line sales over the trailing 12 months. And if we take a look at the company's free cash flow, continuous growth over the past decade as well. And what's very, very impressive is this company's been able to generate free cash flow growth of 21.1% on average over the past decade to over $1.2 billion in the trailing 12 months. Next, if we take a look at the company's dividend scorecard, we can see they have a nice starting yield at 3.5%. They pay out $5.60 per share per year, a 5-year dividend growth rate of 7.14%, and a 12-year streak of consecutive dividend growth. And when you're evaluating the safety of a dividend for a REIT, you want to take a look at the funds from operations payout ratio, not the earnings payout ratio. So if we take a look, the FFO payout ratio currently sits at 5.53%, which is very safe, very sustainable, and allows for future dividend growth in many years going forward. If we jump over to Simply Safe Dividends, they have one of the highest dividend safety ratings possible, coming with a 97. This dividend is considered very safe and highly unlikely it gets cut anytime soon. So ticker MAA for Mid-America Apartment Communities is the first REIT to take a look at. Of course, this is a residential REIT. They own over 100,000 apartments. They've outperformed the S&P 500 over the past 2 decades and have the opportunity to continue to outperform going forward. So this is the first REIT to take a look at. And now if we jump over into REIT number 2, that is ticker DLR for Digital Realty Trust. They currently trade for $106 per share. And the company has seen a major pullback over the trailing 12 months and is now down by over 32%. Digital Realty Trust is a data center REIT, so it operates very different than a traditional residential or commercial real estate company. We can see over the trailing 12 months they are sitting on the low end of the 52-week range with a price to funds from operations ratio of 15.7 and a very high starting yield at 4.6% with a market cap just above $31 billion. And if we take a look at their Morningstar report, this company is also considered to be undervalued at their current share price, with an estimated fair value per share of $142, meaning they're trading at a 25% discount at this current level, according to Morningstar right now. And if we take a look at their investor presentation, they have over 4,000 global customers, they operate in over 50 major cities with 300 data centers located all around the world, and this is the 8th largest publicly traded REIT in the United States market. And if we take a look over a longer period of time, their historical bookings continue to grow quarter after quarter, setting record highs in 2022. And overall, the company has some major customers in their base right now. We see names such as IBM, Oracle, LinkedIn, Meta, JP Morgan Chase, Verizon, AT&T. Their customers are major conglomerates that will continue to need more and more data storage over time, giving continuous revenue growth and expansion for Digital Realty Trust. And if we take a look at their recent dividend performance, over the past 15 years, their dividend has grown at a CAGR of 10% per year to around $4.88 per share as of 2022, and their funds from operations payout ratio has maintained a steady level over the past 15 years as well. And if we take a look over a longer period of time, total revenue continues to expand each and every year from $2.4 billion up to $3 billion, 3.2, and all the way up to around $4.5 billion in the trailing 12 months. And the company's cash flow continues to compound at a double-digit rate, sitting at an 11% CAGR over the past decade, from only $656 million to over $1.6 billion in the trailing 12 months. So again, they've done a great job of generating more and more cash as time goes on. Taking a look at that dividend, a massive starting yield at 4.6%, an annual payout like we saw, $4.88 per share per year, 5-year dividend CAGR at 5.6%, and 17 consecutive years of dividend growth. And if we take a look, they are considered to have a very safe dividend, coming in with a score of 94 from Simply Safe Dividends. There's not many companies that have a massive yield at 4.6% that also come with such a high safety rating. So definitely if you're looking for some massive passive income into your portfolio that's also considered very safe and highly unlikely to be cut, Digital Realty Trust is definitely a company worth taking a look at. So overall, this was stock number 2 in this episode. And now if we continue on into the third REIT we're going to go over, it is ticker AMT, American Tower Corporation, which currently trades for $232 per share. So another specialty REIT, this is a cell tower REIT. If we take a look over the past 5 years, they are up over 70%, including the recent drop, and that does not even include dividend reinvestment. On the 52-week range, they are sitting in the center with a price to FFO ratio of 18.4 and a dividend yield at 2.7%. If we jump over to their investor presentation, how this company operates is that they own parcels of land and the actual cell tower, and they rent out space on this land and cell towers to different communication companies. So AMT owns the tower and the land, but they rent out the floor space and the antennas on the tower to their different communication partners. and 98% of their revenue is generated from this model. And we can see they are operating all around the world. They have over 223,000 different communication sites in North America, South America, Africa, Europe, Asia. This company is globally diversified, and they continue to expand to more and more sites each and every year, only increasing their revenue stream at a fast and compounded rate. And if we take a look, not only are they growing revenue by adding more units, but they're also growing revenue on their existing land. And that's what I love to see from these companies. They're finding more and more ways to grow sales without solely relying on buying more land and expanding and building out new infrastructure. We can see right now the company's focused on getting 3 tenants per location, which will dramatically increase their margins per unit. So right now the company is operating, or how they used to be operating, with 1 tenant per site. That generated around $20,000 of annual revenue. Minus the expenses, they had a gross margin of 8%. But now they've continued to add 2 or 3 tenants per location, dramatically increasing their gross margin, and that could bring it up all the way to 83% if they can get 3 tenants on one single location. And they've said in their latest annual report, they've done a great job of converting more and more companies into renting out as the second or third option at a single cell tower location, which is great to see. And if we take a look at their financial metrics, they are all going in the right direction, which is absolutely fantastic. You take a look at their total revenue. Since 2011 through 2021, they've grown top-line sales at a CAGR of 14.2%, from $2.4 billion all the way up to $9.1 billion. Their EBITDA has grown at the exact same CAGR of 14% to $5.9 billion in 2021, and their cash flow has actually grown at a faster rate of 15.3% to $4.4 billion. So overall, the company continues to grow, and they actually did this while also growing their annual dividend per share at a rate of over 20% annually since 2012. And if we take a look at that dividend, right now they have a yield of 2.7%. They pay out $6.24 per share per year, and their 5-year dividend CAGR is at 17.5% with 10-year consecutive years of dividend growth. And of course, if we take a look at the FFO payout ratio, it currently sits at 44%, which is considered safe and sustainable and gives them more room to grow the dividend in the future. And once and for all, if we jump over to Simply Safe Dividends, the dividend is considered safe with a ranking of 78. So again, another dividend unlikely to be cut anytime soon. So AMT was the third and final REIT we're going to discuss in this episode. Overall, we took a look at Mid-America Apartments Community, Digital Realty Trust, and American Tower Corporation, 3 REITs who all generate revenue in very different fashions. If you're looking for some safe and growing passive income from the real estate sector, these are 3 companies definitely worth taking a look at. They have a strong historical performance of growing revenue and cash flow each and every year, and they're projected to continue to do that for many years going forward. So definitely take a look at these companies if you want some real estate exposure. I want to thank you for watching the video all the way to the end. Please hit that like button and subscribe if you already haven't done so, and I will see you in the next video.